When you're getting a mortgage, whether it's your first time or your second or your third or you're remortgaging, something I found people often overlook is their loan to value or LTV. Now, you're probably aware of it. You'll see it all the time with mortgage deals where you see those percentages say 90%, 75%, 60% LTV, for example. It's really prevalent when you first get a mortgage. So, the deposit you put down is a massive part of the mortgage process and determines the LTV, what mortgage deal and interest rate you'll get, and you can't really ignore it. So it's there the first time, but as you remortgage, you need to pay a bit more attention. Now, in this video, I'm going to explain what LTV is and how you can use it to your advantage and save yourself thousands of pounds, not just in the year or right now, but by cutting how much interest you pay over the entire loan. Now, when you get a mortgage or when you remortgage, there are a number of things you have to think about. I'm not going to go into them for this video, but it's things like checking your credit report for errors, getting paperwork together, and watching your spending and credit applications in the run up to your mortgage application. Now, this is all very important stuff and could well have changed since you last got a mortgage. So, do read up on all of that. Instead, I'm going to focus here on a few simple things you can do that could make a big difference to the monthly and total cost of your mortgage, which is what brings us to loan to value or LTV. So, in a nutshell, your LTV is how much you've borrowed against the value of your house. So, if you originally bought a £300,000 house with a £30,000 deposit, that's a 10% deposit and an LTV of 90% with a mortgage of £270,000. So, why does this matter so much to remortgaging? Well, LTV is measured in bands, and mortgage interest rates tend to drop for each band you move down. And the lower the rate, the less interest you'll pay. So, these LTV bands tend to start at 95%, so that's with a 5% deposit, and then drop in 5% increments, although sometimes the gaps between tiers are larger, say between 75% and then 60%. Once you get to 60% LTV, so when you put down a 40% deposit or have built up 40% of equity, that's usually it for the interest rate reduction. So it probably won't make any difference to the rate if you increase that amount beyond that 40%. Now, to give you an idea of the difference you can get in interest rates based on the size of your deposit or equity, at the moment, you could get a 5-year fix at 3.89% with a 60% LTV based on a 35-year term. This goes up to 4.1% with a 75% LTV, then again to 4.22% with an 80% LTV, and 4.32% with a 90% LTV. So you can see it really makes a difference if you can afford to put down a larger deposit and could mean you save £1,000 over the years because of the lower interest rates. So say you took out a £200,000 mortgage with the 3.89% rate, your monthly mortgage repayments would be around £872, whereas at the 4.32% rate, so with the 90% LTV, they'd be around £924. And as the years go by, there's a good chance your LTV will have changed, so you might get a better deal when it comes around to remortgaging. Now, there are two key changes that could have affected your LTV since you agreed to your last mortgage deal. The first change could come as a result of paying chunks of your mortgage every month and putting more money into your home, which is known as equity. This should be the case for most people if they've got a repayment mortgage, but it won't be if you've got an interest only one. So, how exactly would this work? Well, say you've cleared £15,000 off the mortgage in just equity payments. So, that's not including the interest charges you'll also need to pay every month. Based on that example earlier of the £270,000 mortgage and 90% LTV, you now own an extra 5% of your home, which means your LTV now is 85%. As you've dropped to the next tier of deals, you should be able to get access to a new set of lower rates based on this new LTV. The second way you might have moved into a different band could be because your property value might have increased. So let's say it's now worth 5% more at £315,000, so an extra £15,000. Alongside your initial deposit and the £15,000 in repayments, it would give you £60,000 more equity, or about 19% of that total value. So that means the LTV is now 81%. But despite the LTV being a bit lower still, you'll still not get any cheaper deals than if it was 85%. You'd need to bring it down to the 80% level. When you're really close to a new tier, finding some extra cash from savings or cutting back ahead of remortgaging could be well worth it. Here, an extra £3,000 might seem a huge amount, but the drop down to the 80% band could be a big saver over time. Using our example mortgage size, a 0.45% difference between 85% and 80% LTV tiers over 5 years would be just £2,000, but over 25 years, that variation in rate would be worth £15,000. If you want to have a play around with what different mortgage rates have on your payments, you can have a look at mortgage calculators like the one we've got on our new mortgage hub. Just go to becleverwithyourcash.com/mortgage affordability calculator. So, how do you get a new property valuation for the purpose of reviewing your LTV? Well, using a property listing site like Zoopla is a good place to start. Chuck in your postcode and you'll get an estimate of the current value of your property. But do remember, this is just an estimate, and as we found, it can be quite broad. You can also get an idea from sites like Zoopla and Rightmove as to what price other similar properties have gone for recently. Have a look through the listings online so you can see if the homes you're looking at have a similar layout and a standard inside. Although, again, whatever price you see will just be a guide. For a more accurate idea, you could speak to an estate agent and get them to come over to give you an estimate. And don't worry, there's no obligation to do anything further with them. But you can then use their figure on your application. Once you've done that, the mortgage lender will still probably want to do their own valuation and probably charge you for it as part of the remortgage process. Now, this could just be a desktop valuation where they use algorithms and comparable sales data and other information to work out the value. Or they could do a data drive by looking at the outside of the property, or they might want to come into the house. Now, you probably won't know which one it is, so make sure everything looks good inside just in case. This won't happen though until you're already quite a way through your application process. So if you don't get the value you want, bear in mind you'll have to start all over again with another lender. Now comes the bit where you want to shop around for the lowest rate. So once you've checked the LTV, one option is to just remortgage with your existing lender. This could well be the quickest option and could also mean you don't have to jump through as many hoops, and you could even cut some of the fees. But it could also mean you're missing out on some better remortgage deals with lower rates. Now, if you want to check what's out there, our remortgage comparison tables are a really good place to start. They show you the deals that are available right now, and you can compare over 20,000 mortgages from over 100 lenders. Just go to becleverwithyourcash.com/mortgages comparison table. You could also try talking to a mortgage broker or advisor who'll be able to give you a much better idea of what you could be offered based on your individual circumstances and even ways to boost your affordability. Now, there are a few things to bear in mind when you're looking at different rates. So, firstly, it's really worth seeing what the rules are in terms of letting you overpay your mortgage. Overpaying can save you a fortune in interest charges as well as help you clear the debt earlier. We've got an in-depth guide on whether you should overpay your mortgage over on becleverwithyourcash.com. Now, some lenders won't let you do it at all, while others might have annual limits, usually 10% of the total amount borrowed. The best option is the complete freedom to pay what you want each month and the ability to clear it completely before the term ends. Now, even if you don't think you'll be able to overpay by much, if at all, right now, you never know how things could change, and it's really useful to have that flexibility. Next, watch out for fees. You'll get charged all sorts of different fees with different mortgages, and they can make good looking deals actually worse than the ones with higher interest. The main ones are the arrangement and booking fees. Now, these fees facilitate the deal and could be non refundable, and you need to factor these in to the total cost of the mortgage deal. Do this over the length of the deal, say 3 years, to work out what you're actually paying over time and compare it to one with higher rates and lower fees. You'll also want to consider if you want to fix for longer. So, if interest rates are going to shoot up in the coming years, although this is hard, if not impossible, to know, you might want to look beyond the usual 2 year fixes. There are often 5 and 10 year options available, though you may have to pay a higher rate for these. And finally, check how much you've got left to pay on your mortgage. One reason not to remortgage is when you've almost cleared your debt. That's because the fees that are added to new deals could well wipe out the savings you'll make by staying put, even if it's at a higher interest rate. So work out how much you'll be paying by sticking with your existing mortgage just in case it works out cheaper. If you are considering remortgaging, it's worth looking for new deals around 6 months before your deal ends, as it can take time to get the process approved. Saying that, you can remortgage at any time, although if you do it before your deal ends, you may get hit with exit fees, usually known as early repayment fees. So, generally, it's best not to do it too early, but you might want to keep an eye on any potential base rate changes by the Bank of England. If it looks like there's going to be a significant rise, you might want to switch your deal early to get hold of lower price deals. But of course, you do need to factor in an early repayment charge as well as any changes to your LTV. And if rates start to fall or look like they might, most lenders will let you apply for a remortgage a few months in advance and lock in the rate for a while before you need it. So you can get the new mortgage to start when the current one ends. Now, the good thing here is if rates fall further in the meantime, you're usually not committed. You can simply apply for the new lower rate. And if they don't or they go up, you've secured a cheaper deal. So it's worth double checking you'll get that flexibility. Remember, you can find the latest rates for remortgaging with all the different LTV levels over at becleverwithyourcash.com/mortgages. And that's it. Thanks so much for watching. Check out these videos here for more ways to make the most of your money.